Welcome to Chit Chat Stocks. This is our weekly Power Hour episode. I'm one of your hosts, Ryan Henderson, and I am joined, as always, by the one and only Brett Schaefer. We've got plenty of topics to discuss this week. One major acquisition. We got some bubble watch topics. My voice might be a little bit hoarse. I've been at a conference, which actually gave me quite a bit of anecdotal evidence and also bubble watch topics. So apologies if I start to lose my voice throughout this episode, but we have plenty to discuss. I've got a nice small cap of the week, one that I've been researching for quite some time, or I guess eager to research for some time. And I'll leave it at that. Brett, welcome in. How is everything?
It's going well, Ryan. You were at a conference last week, Future Proof, and I did notice while seeing some of the clips online that our favorite Bitcoin advocate, Michael Saylor, was talking. Did you do the Mark Baum from The Big Short and ask him a question and then just storm out of the conference? You
And
know,
hold up a zero? No, I did
yeah.
not.
What
It's quite
what
an
are the chances you default on your Bitcoin loans? And he goes, well, we've seen some volatility, but there's a 0% chance, or we see minimal disruptions to our long-term strategy. And you just get up and start yelling, zero.
it
I
made me
wish he.
realize that because it was a kind of it's definitely an intimidating atmosphere to do that kind of thing. That Mark Baum guy must have had zero regard for what anybody thinks of him. So kudos to him. The conference was good. A lot of people in the financial media space, tons of advisors. Yes, Michael Saylor was there as well. Bit of a bizarre keynote that he gave, but it definitely attracted the biggest crowd.
What? Bizarre? I'm shocked, Ryan. He had a
Yeah,
bizarre
not
keynote?
it's interesting that he's such a champion of Bitcoin because he kind of lacks a little bit of charisma. Like, it's not like it wasn't particularly well spoken, I didn't think, but tons of people turned out for it. Same with what's his name, Tom Lee, I think from Fundstrat was there. He got quite a big crowd as well. Anyways, there's plenty to discuss from it, and I will talk partly about the Bubble Watch. I'll talk about the Michael Saylor live event. But before we do any of that, I want to talk about our friends at Public. If you are serious about investing, you need to know about public.com. That is where you can invest in everything: stocks, options, bonds, crypto. They even offer some of the highest yields in the industry, like the bond accounts, 6% or higher yield that remains locked in even if the Fed cuts rates. What sets Public apart is how they give you the tools you need to make informed investment decisions. Their built in AI tool called Alpha doesn't just tell you if an asset is moving, it tells you why the asset is moving so you can actually understand what's driving your portfolio's performance. Public is a FINRA registered, SIPC insured, US based company with a customer support team that actually cares. Bottom line, your investments deserve a platform that takes them as seriously as you do. Fund your account in 5 minutes or less at public.com/chitchatstocks and get up to $10,000 when you transfer your old portfolio. That is public.com/chitchatstocks. Paid for by Public Investing. Full disclosures in the podcast description. Now, Brett, the other thing I was going to mention from this conference, it is a little funny because they bring like they make a concert out of it, and all I can think is these bands have probably like to be a fly on the wall in the room before they actually come on stage. They're like, all right,
This is
guys,
the worst
corporate
audience.
event, here we go.
Yeah, exactly.
Yeah, they didn't seem too fanatic to be there, but I want to start with Google and their, I guess, major acquisition here. Do you want to maybe dig into some of it?
Sure, Ryan. All right. Let's talk about this Alphabet buying Wiz. It makes me think of one of those Seinfeld episodes for some reason where there's the guy named the Wiz. People, you might not remember that one, but for some reason that came to mind. We had a lot of listeners asking us to talk about this one. It's not, in all reality, it's not going to be material to Alphabet's business, but I think it's interesting because it's one of their largest acquisitions ever. And I think by dollar value, the largest acquisition ever. So they must see some promise within this division, within this startup. It's an all cash transaction for $32 billion. I don't, I'm far from an expert on the cybersecurity space. So I pulled some quotes from the press release. I think that kind of helps understand what their motivation is here. Quote, this acquisition represents an investment by Google Cloud to accelerate two large and growing trends in the AI era: improved cloud security and the ability to use multiple clouds. Quote, Wiz delivers an easy to use security platform that connects all major clouds and code environments to help prevent cybersecurity incidents. Apparently, this is for around 30 times forward revenue. So they're about to, well, the projections are for them to hit $1 billion in revenue in 2025. This startup, I think, was founded only back in 2020. So it's an incredibly fast grower. It's from some seasoned like technology and software and cybersecurity people. So it was not their first venture out of it. It's not like they started small. They had big backing, they had the relationships within the industry to get started. And it looks like this product just caught fire. And Google thinks they can supercharge it by adding it to their portfolio within Google Cloud. Two questions I have though. Can you not build this yourself? And I think probably not, because you have to have that multi-cloud strategy. I guess maybe I have three questions. And the second one is the fact that you're going to be owned by Google Cloud going to ruin this multi-cloud strategy with working with the Fortune 1000 companies? And then second, or sorry, third, w- doesn't rev with this multiple, I mean, doesn't revenue need to 10x from here to really make
Yeah.
this one worthwhile? The what acquisition at 30 times sales ever makes sense, Ryan?
Some of their previous ones, probably. YouTube,
Ooh, yeah.
uh,
Well,
uh,
yeah.
DoubleClick. I mean, pretty much every huge
Do you
acquisition
think
that's
do you
been
think
a success
DoubleClick
for
was at
them.
do you think DoubleClick was at 30 times sales?
I don't know. I think it was in its infancy when I bought it, right?
I don't think so, but we
What
can
was
check.
the one they
YouTube
bought where it was really
probably.
small? There was one that they bought that was tiny and it ended up being a huge deal. The I mean, with Google, there's obviously a major distribution advantage. So, like, we talk about it all the time. I mean, for one, they control 7 properties that have more than 1 billion users, so they can certainly get in front of people a lot easier. They obviously have more, enterprise, relationships, more business relationships that they can, uh, kind of leverage as well. So I know it's kind of a weak point, I guess, and people always say this, like, well, it can, they can supercharge growth once they're under the umbrella, but I think Google has shown time and again that having massive distribution is like a huge advantage when they end up acquiring a company. I do agree with you on the second point, which is like, will customers be I guess I need to get a better understanding of the product, but will they be concerned about going multi-cloud when it's under Google's umbrella? There's a quote, I think they had a presentation on the Wiz acquisition maybe this morning, and there's a quote. It says, "Together, we believe this and Google Cloud can accelerate the ability of organizations to improve their security, lower the cost to do so, and ultimately spur the adoption of multi-cloud and cloud computing for customers, partners, and the industry as a whole." It it sounds like I imagine it doesn't totally disrupt people from going multi-cloud just because it's under Google's umbrella. There's probably products that they offer that just make it easier. Even if it's in Google, I don't think they're going to stop the. They're not going to deter people from also using AWS and Azure just because it's under Google. I think the product here is intended to help people use multiple clouds, and if that's the case, Google, being the smallest cloud provider of the big three hyperscalers, is most poised to benefit.
Yeah, that makes sense. One thing that doesn't make sense to me is, why does this help with Wiz's distribution? Is Aren't they already selling through Google Cloud? What changes?
I'm not totally sure. I don't know the business well enough to be. Yeah, I just there's no. I think any business would gain a distribution advantage being under Google. So,
In what capacity though? And within Google Cloud, it's not like they're going to be within Google Search and YouTube. That's irrelevant here. They're already selling on Google Cloud. Apparently, it's a very hot product, so Google Cloud has been pushing it hard. What changes?
oh, you could get preferential ad treatment across the rest of the ecosystem, but and that might be potentially illegal, but you could get I mean, Google Cloud has other they have relationships that Wiz probably doesn't. I mean, part of it is probably there's a handshake element to this, which is Google Cloud has worked with a tons and tons of customers, and now they can offer this beyond how they were already offering it. I assume it was a part of like maybe a app marketplace or something.
Yeah, that's what I'm saying is Google Cloud is already working to sell Wiz, or Wiz in the other hand is working to sell Google like through Google Cloud. Like they're already. I
Just
just don't know
in
why
like an
this
app
had to.
marketplace or
Well, I'm just like, okay, if they're a multi-cloud company, if they're supposed to sell through Google Cloud, they're already working together. I just don't know why the Google Cloud sales team is gonna suddenly go, "Oh, this super hot product that everyone wants, now we'll start selling it because it's under our umbrella." Aren't they already trying to sell it?
they're not getting commissions on Wiz.
I bet they are
They
because
might
it
be getting
yeah.
some sort of a referral fee, but they're not getting true commissions. I think it there has to be some sort of a distribution advantage here, and there must be some way that they believe they can extrapolate growth a lot further.
Hey,
Also,
better work, better work, better work. It's at 30 times sales. There's just given base rates. I know it's a term that people use to try to sound smart, but in this case, 30 times forward, I think it's 60 times trailing sales. The My hunch is that it doesn't work. And it just buy back the stock instead and build it yourself, or I don't know. It just seems would be frustrating as a potential Alphabet shareholder. I did look up DoubleClick, reportedly about 10 times revenue, maybe slightly less, maybe 9 times revenue. So pretty pricey, but not 60.
they could have paid 60 and they would have been just fine.
Yeah, but it okay.
It's
Would it have been worth it to build yourself? Again, you just have to think of capital allocation decisions.
I think it's a lot easier for us to say, why can't you build it yourself? Because we just kind of take this picture of Google has unlimited employees and resources and they could just build anything. But I think it's more complicated than that. And building the tech isn't as easy as just allocating resources to it. My suspicion, my hunch is that 10 years from now, we look back on this and we say, yeah, it probably worked out fine. We probably won't even get the exact numbers on it because it'll just get lumped into Google Cloud. But I just think I know a lot of people tossed around that chart of like best acquisitions of all time and Google being up there with like 4 of the top 10. I do think there is some like the proof is in the pudding here. They've done a really good job in the past integrating these and supercharging them. I kind of want to give them the benefit of the doubt.
Yeah, sure. You can also say that about Fitbit. I don't know. They're not perfect,
True.
you
I mean,
know?
they could, yeah. I assume they've missed on some other stuff too.
I
Um,
just, I don't know.
it does
Eh,
frustrate me that they're doing this when they could at a time when maybe they should be buying back instead. That I understand because I think if it were trading at 25 times earnings instead of 15 or 16, whatever it is, that might be a time to kind of get more acquisitive. Is it? But this was an all cash deal, wasn't it? Too.
Yeah, it's an all cash deal. The way I look at it is this. Look, the Google Cloud numbers are going to continue to be great. If you add on Wiz here, that probably supercharges it a little bit. Maybe if the acquisition works out by a lot. But adding again, just think about this like 30 more billion dollars in capital expenditures. It's more to what you've put into this business and the growth needs to and the earnings potential and whatever 10 years down the line, the earnings need to be that much higher because of this. And I would be curious to know, we're not going to know for a long time, and how fast Google Cloud's revenue growth is going to be and how fast their earnings growth will be with or without this company under the umbrella, because regardless of Google's acquisition track record, which I agree with you, is undisputed. Take take this type of acquisition in a vacuum. A strategic acquisition, synergies in sales at 60 times trailing revenue, quote unquote 30 times forward, which may or may not actually materialize. Most of the time, these are dumb. Most of the time, these don't work.
Yeah. Yeah, it's possible. We'll see. And I mean, I would be curious to hear from someone that's I'd like to get a better understanding of what Wiz truly does and listen to I don't know, maybe some sort of an industry expert that has a sense of whether or not this benefits Google Cloud more so by if the whole world if multi-cloud becomes more and more popular over time, you assume Google Cloud is one of the companies that benefits there. Is it
Right.
better to have it under Google's umbrella? I'd kinda wanna hear that from someone that maybe understands the industry better.
Right. Yeah, we're not gonna have that. We have a comment here that says, "What if the CEO of Wiz replaces Sundar? Is that worth $32 billion?" Then look, the CEO, the founder of Wiz, was his previous startup got acquired from Microsoft, and he just left 2 years later when he could. So I would maybe expect that the same thing happens. The
Yeah.
founder aspect is
Yeah, for sure. I
not gonna
mean,
be there.
these okay, you just gave the experience here. Typically, people that like to build companies and get acquired, that's their exit, whatever, they like the startup atmosphere. They like building a company from the ground up. They
Mhm.
don't like being a part of a massive conglomerate and building for the benefit of somebody else. Um, so yeah, my suspicion is that he stays on as long as he's contractually required to be on, and then he's gone. I think that happens with most acquisitions.
Yeah. Yeah, or you have to incentivize them to stay on. I do love the deals where you have earnout plans over like a 5-year period where you have to hit these goals. Like, look, you're not just going to leave us holding the bag here and ruin this subsidiary when you leave. I do like those type of deals a lot more than this one, where it seems like within this industry, software technology in general, they go, well, we're going to acquire you for a huge price, but there's no contingency plan, which I don't like too much.
Yeah, I would suspect a lot of these. I suspect this will have certain earnouts.
Well, they
Did
didn't
it say?
say
They didn't
I
say
didn't
any?
see it in the press release, but who knows? Maybe it'll be in some sort of proxy filing or whatever filing it is.
Yeah, I feel like most buyouts have some sort of an earnout clause. Could be wrong, but anyway, yeah. Well, we'll see. It would be great if they continue to provide clarity on the actual numbers here. This will also be a good gauge of what the sentiment is like within the regulatory world as to whether or not these acquisitions can go through again, because it might kind of open the floodgates for another barrage of big tech acquisitions. We'll see. Uh, my
It would be
guess is
better
this
for
takes.
everyone. Or sorry, my hot take is it would be better for everyone if they weren't allowed to acquire them, and then this company was forced to go public and make the market that much more competitive.
Yeah, yeah, potentially.
You
All right.
wonder why the IPO market is closed, Ryan. You can sell at 60 times sales to a big tech company. Oh wow, why would we go public?
Yeah, I mean, there's like some validity to that. Like you have there's a lot of baggage to going public that a lot of people just don't want to deal with. And there's you can either stay private and just kind of get perpetual VC funding, although at some point they're looking for an exit. You can sell to big tech. I mean, the ways founders like to exit is either acquisition, IPO. Some people consider that. I think a lot of founders consider that an exit, which is kind of rough to hear for public shareholders.
Don't buy an IPO. That all this all says don't buy an IPO. Just wait. Just wait. The price will likely go down 50 to 70%.
Yeah. All right. Let's shift gears a bit. Um, I'm sure there's some other exit strategies for founders, but I think acquisition is probably the preferred one for a lot of these people because it allows them to relinquish their hold on the company too. Like they can go start
Mhm.
something new, run and have a new life, not have to work at the company anymore. But
Yep. Clean break, not complicated. Sorry. Next segment.
5 stocks trading at their lowest valuations ever. I'm curious if you're interested in any of these. I know I already kind of know you are, but I'm just going to rip through them, and you can kind of use whatever multiple you want. I tried to find ones that were like consistent over time and didn't change too much, depending on the company. So, first one is Amazon. They are trading at a current EV to EBIT of 30.6. Their historical average is like 85 because it's always understated. Uh, Second one here is Adobe, current EV to EBIT 21, historical average 42. Third one is Salesforce, trading right around its lowest free cash flow multiple ever. Fourth, Airbnb. I used operating cash flow. Now it's a little inflated, the actual operating cash flow figure, because of some of the working capital dynamics there. But it is trading at, I believe, its lowest EV to operating cash flow ever. And then the last one is Uber. So those are the five: Amazon, Adobe, Salesforce, Airbnb, and Uber,
Is
all
the
trading.
Amazon one, do you have the notes here flipped?
Yeah.
Okay, so
Yeah.
the
I
current
accidentally
is
messed them up.
30. Yeah.
Yeah. The, and you can, if you use EBITDA, Amazon is like
Don't
17
do that with
times, but
don't. Mm-mm-mm.
that's flawed math. The, out of those five, which those interest you the most?
Let me just go top of the noggin here, 1 through 5. 1, Airbnb; 2, Amazon; 3, Uber; 4, Adobe; 5, Salesforce.
Yeah.
What about
I
you?
agree with that.
I feel like
I
you'd have
might
Adobe a little higher.
potentially, although I like Amazon a lot, and that's the widest moat on this list. I might swap Uber and Airbnb potentially from your list there. I think
Right.
Uber's, just on the current valuation, I think it looks a little more attractive than Airbnb, but there is the Waymo risk, and it seems like they're starting to kind of move past the Waymo risk a little bit, in that that partnership seems very amicable, like, or mutually beneficial. People, apparently, I'd love to get some stats on this, but apparently a lot of people are booking the Waymos through Uber. Um, Maybe not in Silicon Valley, but I believe in Phoenix they are exclusively on Uber.
That's not true. I
No?
was in Phoenix. I didn't take a Waymo, but I tested it out, and there's a specific Waymo app. It seems quite easy. Didn't use it, but funny enough, it was actually cheaper. I think they're selling it at a loss right now for sure, but it was cheaper than the human driver on Uber.
That's what I would think is the case. I would think they're the low cost provider, but
Yeah,
most
but
of the time they're not, right?
well, the cars cost about $250,000 to make, so even including the human driver aspect of it, I don't think most cars driving around on the Uber X are that expensive. So I think there's a little bit of a different cost structure there. When I look at Salesforce, Ryan, that one is it's kind of an enigma. As we followed before, Benioff, unique figure, loves touting his friendships with celebrities. They have a partnership with Matthew McConaughey. There was a quote from, or excuse me, a tweet about how many employees tech companies have. And the first two here make sense, but then we'll compare it to Salesforce. So Microsoft, 228,000 employees. Google, 180,000. You want to guess how many Salesforce has?
I think it was like 75, right?
75,000. I think if we just want to grow earnings, we cut that by 3,000 a year for the next 10 years, and you still won't have a shortage of supply of employees for this company. I mean, think about how much smaller Salesforce is than these tech giants.
Yeah. But they've wanted to be big tech for a long time. They've wanted to be in the big tech conversation for a long time. Thus the Salesforce Tower,
The tower, Dreamforce.
thus basically having 0% operating margins forever, because they try to pay their employees as much as possible, and want to be known for their compensation. The it's I don't like Benioff, and this is one where I think Sean Wang was right. We had a conversation with him on who would be the biggest losers from the proliferation of AI, and AI applications, and he said basically legacy tech. And some of the quote unquote legacy tech I don't agree with. Like, I don't think Adobe is that up for disruption. I could be wrong, but on the enterprise side, I don't think they are. Salesforce deeply embedded, but I think that's a product that's easier to replicate than creative software. And
With AI, you're saying with these new tools, with this new paradigm we're in.
yeah, just AI making it so much easier to build applications quickly. I think Salesforce is bound to have a lot of competition, especially I'm seeing it at the startup level. There are a lot of CRMs that are, well, I mean, there's just a ton of CRMs in general, but i- Salesforce is kind of one of the more expensive players, if I'm not mistaken. And so it just makes more sense to start with something smaller or something lower cost. And then once you are starting on that, switching CRMs is a pain in the butt. So maybe for these big tech companies, Salesforce is going to be able to continue raising prices. And I've heard it's extremely sticky from a lot of sales reps, but I suspect kind of like Adobe, they're going to be, and you're seeing this in the growth rates actually at both companies. Salesforce is now growing single digit pace for the first time ever in its history. And Adobe, I think, is actually kind of right on the fence as well. It strikes me as just the individuals, the creator, like the freelancers, all that startups are shifting more and more away from these products. I think you can still make money as an investor in Salesforce, Adobe, quote unquote legacy software purely from enterprise growth, but my suspicion is that the growth rate is a much smaller over the next 10 years than the last 10.
And you can even add Uber in there if you're talking about AI disruption risk. That's what people are talking about, really, if you count the self-driving cars as disruption. When I look at this list, Adobe, Salesforce, and Uber, there are risks here that I'm not comfortable making a decision on. It really reduces my conviction in these businesses. Now, if you're someone that likes these companies and has some sort of differentiated view, you have some different information than I have, you just come to a different conclusion, you say these risks are totally overblown. Well, these are buying opportunities. But when I look at Airbnb and Amazon, now specifically Amazon is attractive. Well, Airbnb as well, because that it's not that expensive at the moment. But Amazon, I think they can grow their profit margin, their EBIT margin can go up by 50% over the next few years. And when you combine that with revenue growth, this EV to EBIT of 30 is going to go down to 10 to 15 really quick.
Yeah. It's amazing how much more fragile, I guess you could say, a digital moat is versus a physical moat. And Amazon has one of the biggest physical moats in the world, probably the biggest. Airbnb, you could make the case, does as well because it's housing supply that is a physical advantage, housing supply on the market. And you would have said, I think, Uber has physical supply on its marketplace too, but those cars, I guess, have been more or less turned into computers, and now you're competing with literal computers in Waymo. So,
We're not going
y
to get AI disruption to homes, I don't think.
no, you're
So,
not gonna get AI disruption from homes, and I don't think Amazon logistics infrastructure, obviously, AI is deeply embedded in all of that, but the physical footprint is you can't replicate it with AI.
yeah, if anything, you could argue that both these businesses, Amazon and Airbnb, had the potential to play offense and further widen their moat if they use these AI tools smartly. Sticking on what would you rather buy here, I had a similar question, and maybe hit this quickly. I'm looking at the four hyperscalers, if you include Meta in there. Meta, Amazon, Alphabet, Microsoft, all as of this write or as I wrote it yesterday, in a 20% drawdown, give or take. Gut check. Which one are you buying?
So, okay, I like Amazon in the long run the most. Feels like the most the widest moat, I guess, but the I worry about the next 2 years and earnings looking not quite as good as this last year. Like we saw insane margin expansion at AWS. I think it was up 1,000 basis points or 10 percentage points for anyone who doesn't talk basis points.
Right. That so that can normalize as your fear, and people aren't expecting that.
I think in an AI slowdown, they would be you'd get slower AWS revenue growth, but you'd also have you're seeing increasing costs because they've talked about all the capex that they're spending on data centers. Um, if you're seeing a slowdown in conjunction with the big data center spending, there's going to be some margin contraction at some point. So yes, I would be long term. I think Amazon's margins are higher, but over the next 2 to 3 years, I'm a little worried in an AI slowdown world. But yeah, I like Amazon. That is a little too expensive for me. I like that business probably the second most, but then it'd probably go for me Amazon, Google, Meta, Microsoft.
I think I would go Alphabet, Google. I was looking up the earnings multiple here. It's 20 trailing, 17.5 forward. Not dirt cheap, but cheaper than these other ones. I'd go Amazon second, and then Meta, then Microsoft. I think Microsoft, maybe that valuation has come down because of this drawdown, but I always look at it and go, okay, yeah, 10 something, 10% plus revenue growth, but we're at what, 40 times earnings? It just doesn't do it for me. Better than Apple, which would be, those jokes that people do like one, two, three, four, and then a huge gap, and then five. That would be Apple for me. But I think, and we had a comment here that someone said Meta. They would have Meta as their number one. I think Meta, again, in a bull market, in times like these, people I think underrate sometimes just or don't consider as deeply the difference between. Oh, wow, Meta's valuation has come down. Maybe I'm wrong here. Okay, but in general, I think if something's trading at 35 times earnings versus 15, that gap doesn't feel as wide when stocks are just going up. But maybe Meta is not that high. It says the trailing valuation is a PE of 25. Forward is 23. Huh. All right. Maybe
So
it's
you're
closer
just
than I thought.
revising all your
I
takes.
might be revising that. Yeah. I haven't looked at them closely in a while.
So yeah, I don't know. The big tech, I I think you'd other than Apple, I think you'd probably get okay returns with all of these. Amazon, I think you get Amazon and Google would be the ones that I think you get the best, but it's
Nvidia is
been
a
a
wild card.
yeah, it's total wild card. Because I mean, who knows what the growth rate looks like? And I'm seeing a
Yeah.
lot of people referencing the trailing multiple and thinking, well, look at the trailing multiple and the trailing growth rate that, if this continues, and it's like there's just
Yeah. It's like that meme
so
of
unlikely.
it's the meme of the guy about to get hung first time. That's what we
Yeah.
did when we first started out investing.
Okay, I want to talk about some sponsors real quick. Blue Chippers Club, huge shout out to these guys. The club is totally free. Someone reminded me to mention that it's free right at the start of the sponsorship. It is. For anyone that doesn't know, it's a tight-knit community of stock-focused investors. They have weekly calls. You can pitch stocks on there. You can put your portfolio on there. It's like just a nice online forum to have deep conversations with other investors. I recently put my notes up for our portfolio rankings episode, and I got a lot of great feedback. So I'm really enjoying that community. Started by two friends of ours. They're working on building it out. Like I said, 100% free. So if you're interested, head on over to bluechippersclub.com and hit apply. The link will be in the description. And then one more time, I want to talk about Public. If you are serious about investing, you need to know about public.com. That is where you can invest in everything: stocks, options, bonds, crypto. You can even earn some of the highest yields in the industry, like the 6% or higher yield you can lock in with a bond account. Public is a FINRA registered, SIPC insured platform that takes your investments as seriously as you do. Fund your account in 5 minutes or less at public.com/chitchatstocks and get up to $10,000 when you transfer your old portfolio. That's public.com/chitchatstocks, paid for by Public Investing. Full disclosures in the podcast description. How about small cap of the week? You want to talk small cap?
I was about to ask the same thing. Looks like we got Herc Holdings. Interesting name for a company, Ryan. I've never heard of this one before, but you seem excited to talk about this one. So, what is it?
Yeah, weird name. It sounds like something related to Hercules, but no, it is the third largest equipment rental company in North America. Um, this wasn't a listener recommendation or anything. We've been getting a lot of those lately, and I appreciate that. But this is just one I've been interested in for a while. It's a $3.8 billion market cap, although they use a lot of debt, so the enterprise value is substantially more. And I've already taken a brief look at the two largest players. So the two largest are United Rentals and Ashted Group. Now, Ashted just owns Sunbelt, which makes them the second largest player, but I think they're UK listed, if I'm not mistaken. So it's a UK company that owns Sunbelt, which operates in the US. I don't know, kind of
Right. I've seen those.
funky.
Yeah, I've seen that
Um,
name before.
yeah. Anyway, the market share of the industry is basically 17%. The largest player is United Rentals. Second largest player, Sunbelt, 13%. Third largest, Herc Rentals, 4%. And then most of the industry, more than 50%, is just smaller players, small equipment rental players. Really, you can kind of specialize by industry, within the equipment rentals as well. And there's just there's something to like about this industry overall, at least I think so, where there's a lot of economies of scale by if you have a lot of branch locations in certain regions, you can get you're able to deliver quicker, which means you're able to deliver at lower cost. You can share resources across those locations. You can have big like national accounts, because and you can service those national accounts because you have different branches in different spots, and so there's just kind of these continuous small advantages of being the big player when you're competing against majority smaller niche focused players. So it's a lot like the home improvement sector with Home Depot and Lowe's. um, and so they've got 451 total branches in the US and Canada. It's a bit smaller than United Rentals on the branch side, actually significantly smaller. So United Rentals, for context, has 1,700. And the business model is fairly straightforward. Basically, Herc owns a bunch of equipment and then rents that equipment out on an hourly, daily, weekly, or monthly basis. In addition to rent, the company charges for equipment delivery and pickup, liability protection, fuel, environmental costs. There a whole bunch of ways they can kind of charge, depends on the deal. Um, but they tend to get, I'm trying to remember the exact number, but they tend to get back 100% of the equipment's cost in rent within like 4 years, I believe. And the estimated lifetime value of these is typically around 10 years. So the
And
way
they're
it kind of,
buying this equipment.
yeah, yeah. So the way it kind of goes is and 4 years could actually be wrong, but they tend to get the rental income to pay off the cost really quickly, in terms of the overall lifetime of each piece of equipment. So you think about it, it's like you pay $100,000 to buy some industrial machine. Then over the next, call it 2 or 3 years, you're renting it out on hourly, weekly, monthly basis to general contractors, and you make your money back through rental income plus all the other income sources that I mentioned there. And then from there on top, it's basically all uh, profit, right? Other than like servicing it as well. But most of the capex is more growth capex, and then they sell it around year 7 or 8. Each machine typically. They try to keep their fleet at around 48 months, like lifetime fleet age.
Average age, yeah.
Yeah, and then they're able to get usually, I think it's like 50% of the equipment cost in year 7 or 8 when they sell it, which is nice. So there's good economics. Um, Herc is quite profitable, so they do about 3.6 billion in revenue, and they generated 743 million in operating income. So, and now keep in mind there's a lot of interest expense because they're taking this levered strategy, but the EV to EBIT, which takes into account the debt load, stands at about 12 times in a period when there's been a bit of a construction slowdown. So I think you're getting potentially reasonable multiple in sort of a construction trough, if you will. Now, it's kind of hard to predict the cycle, but we know that like construction is not surging because recent hike in interest expenses, or sorry, interest rates. So it's like slowed a lot of projects. But the biggest risk here is just industry slowdown. I think their debt is well covered, and they should continue to gain share. I don't think they'll ever get to the United Rentals uh, market share, but they should continue to kind of gobble up a lot of the smaller players. So there's a lot of consolidation in this industry as well. It seems just well positioned for a solid return.
Okay, that's a great introductory overview. I would have a few questions. I'm not sure you'll be able to answer them because, again, that's just introductory research on this company. But the ones that come to mind that I would want to research further on first, and this kind of comes up right at the end here, how exposed are they to Florida and Texas, which I think is maybe a place with more oversupply compared to somewhere else that might have potentially undersupply and a potential for more of a construction boom. Although, again, through the cycle, it's not going to matter too much. The second one I would have is what is their plan with the debt? Are they going to pay it down? Are they going to specifically try to consistently have 3, 4, 5 times leverage? Is that part of their strategy? And then second is, and I'm going to share the screen here, or sorry, third, last question, most important is we're going to use the chart from FinChat that I pulled up here. It's operating income versus free cash flow. And besides the 2020 pandemic period where free cash flow was above operating income, it looks like free cash flow has trailed operating earnings every year. I think net income as well would still be within that, even if you include that interest expense. It's lower every year. I think I know the reason for that is because they're investing in new equipment, but does this change at all as they scale? Does this hold back the business model? Because, and you might call me a stickler, Ryan, I almost have a hard rule to not invest in these type of businesses where I just remember the Munger quote, "We don't want companies where the profits are stuck in inventory sitting on a lot."
Yeah, I'm not exactly sure what happened in 2022, 2023. Maybe that's just like a bullwhip from COVID.
I
But
think I'd guess for that, yeah, as well.
if you look at United Rentals, they tend to have pretty good conversion, uh, real free cash flow conversion relative to their operating income. So if you kind of believe Herc can turn into or mature in terms of its unit economics more like United Rentals,
That'd be a good sign, yeah.
I think there's the potential for that.
We have
The
2 questions here. These would be other ones that I would ask is why hasn't private equity bought Herc? That is either a concerning question, like will they see something wrong with this business or the potential for some solid returns over a short time period? And then second, are they expanding locations and rolling up smaller players? Did you see that at all? Or again, just something to look out for?
they have been acquisitive. Not I haven't looked at their entire acquisition history. I believe they've done some big ones actually, and they maybe did a pretty big one like last month. Um, so yes, pretty acquisitive. I'm not sure on why private equity hasn't bought them. They were spun out of some company, I think around 2014, 2015. So I don't know if like private equity wants to buy a new spin out. They were probably loaded with quite a bit of debt from that as well. I know this has been a big Bill Ackman holding for quite some time.
Uh
They may have
oh.
Ackman might have sold recently, which may have contributed to there's been a big sell off. I think it's down like 40% or something like that in the last like 2 months.
It
So
does look, it looks cheap ish, potentially cheap.
yeah, the other thing you mentioned, the Texas, Florida concern, commercial and residential construction is like 30 mid 30% of their business. So they have a lot of like chemical type
Okay.
end markets. There's pretty diverse end markets for all this construction equipment. Um, there's like disposal systems. It's really quite it's kind of all over the place, which kind of helps smooth it out in case there is a slowdown in residential or commercial construction. But
Yeah. Or never say never, but a slowdown in data center buildouts. That would never happen.
yeah,
Who?
which actually has been a growth market for a lot of these guys.
Yep.
So yeah, I could certainly see that potentially hurting them a bit.
Taiwan
Well,
Semiconductors helping all.
Yeah.
They are a blessing to the reshoring of the United States.
Let's do bubble watch because I want to talk about this Michael Saylor speech.
Yes,
Uh,
let's do that. Well, let's highlight though, Ryan. I used that FinChat chart. Let me just tease the listeners or tell them that they can use our link, which is in the show notes, or just the URL is fairly easy to memorize. finchat.io/chitchat. Get 15% off any paid plan. It is well worth it. You can easily research products. There is tons of things that you've seen us talk about all around the show, and they're adding new stuff every single quarter, like the customizable metrics to make charts and graphs to help your research. If you are an individual investor that has a sizable portfolio, you're someone that loves fundamental research, or if you work in a professional capacity, it is well worth the money. So go try it out, finchat.io/chitchat, get 15% off any paid plan. Yes, Ryan, Bubble Watch.
so yeah,
What do you got
Michael
here?
Saylor. To paint, let's paint a picture here. So
Miami Beach.
Miami Beach, future proof. It's like it's literally on the beach.
You're
It's a
watching the
actually
fray, right?
quite
Wasn't the
yes, but they were like a late night event kind of thing. Pretty well run event actually. I really enjoyed it, and I think sometimes it's worth it if you just want to expensive tickets. But if you're in the industry, it's worth it just to kind of meet people and connect. So it's on the beach and it's kind of fenced in. You've got this area, you got to have like admission passes, that kind of thing. And Sailor pulls up in a tinted window, blacked out Escalade, gets out in a full, just black slacks, black suit jacket, and a Bitcoin shirt, like a
Yeah, I know his
custom
Bitcoin
Bitcoin shirt,
shirt.
which he
Yeah,
sells, I guess. And
that's
then
their gonna be their future business model.
he actually looked very hungover, but that's beside the point. And he kind of got up there for this conversation, and I tuned out. I don't know. I didn't listen to the whole thing, and it was kind of it was packed. And when you're like listening to something where you don't agree with a lot of it, and it's like just kind of hard to hear. That was sort of me most of the time, but there was definitely a lot of points where he was kind of losing people, like people that agree with him, liked him, were so excited to hear him talk. We're like, oh, I don't know if
They give their
that really
friend the
makes
elbow and they
sense.
go
Yeah,
they give the,
yeah.
to the elbow to the people next to him like, Okay, where's he going with this?"
Yeah. What I realized is that he's kind of in this difficult predicament that he's put himself in. So MicroStrategy trades, or Strategy now, they've changed their name, trades at a significant premium to their Bitcoin holdings, which doesn't make a whole lot of sense. And it's not something that, like, if you want exposure, if you're saying, well, Bitcoin's got upside, that's what's priced in, then just own Bitcoin. And there is a software business here as well, but that just doesn't matter. It's in the grand scheme of things, it's so small, it does not affect MicroStrategy's overall valuation. So people just seem to invest in this purely because they like Michael Saylor. And he's getting asked at these conferences to basically explain, why is your stock still undervalued? Like, why does it still have upside from here? And
I mean, what does he even say? Like, "We buy Bitcoin." Okay.
it was actually just a word salad that made no sense to me, and I think that's where he lost a lot of people. But it's it makes me realize he has to say more and more outlandish things to. It's an impossible question, right? You're like, if I just bought 100 Bitcoin and someone said, "Well, you're worth 200 Bitcoin now," like, and then someone asked me, "Why are you worth even more than that?" There's no right answer, right? Like, so you have to just like make up claims or try to come up with some sort of rationale. And so it just kind of made me realize, like, the worst place to be in, I think, for a company is to have that,
An
to have
extreme
an extreme
overvaluation.
overvaluation.
Yeah.
It makes it the hardest to run the organization because you're going to get, that there's kind of going to be pain at some point in the stock price ahead. So I don't know. I sort of felt like felt kind of bad for him a second for just a little bit when he was asked sort of this impossible question, but then I realized that the reason they traded this is because of the claims he's made to begin with. So
Yeah.
it's really, I don't know. It was interesting. That was certainly the most well attended, if that gives you any sort of gauge on the sentiment.
Boy. Oh boy. I wonder when the crypto people are going to actually hang up their hats. Are we going to be like 50 years from now? Just wait. It's going to start meaning something and it's going to do something in the world. And instead of just Patty's dollars, just circle, circle, circle. We're not doing anything.
Yeah, I wonder at what point it goes from where people are no longer talking about the price as the primary reason to own
Mm.
it. Like if
Well,
there's some sort of a utility, then and you know what? People tell me there's all these utilities. I am yet to see a huge real world application where it's like made some part of my actual day-to-day life easier. So I I'd be curious to see if that ever happens,
well, Ryan, you just haven't done your 100 hours of research.
I guess. But here's the thing, even if you are optimistic about it, why would you own it through MicroStrategy?
MicroStrategy. Yeah. Well, they're just gonna sell a lot of stock and buy some more Bitcoin, and that'll help you when you own it at that price. Yeah, it doesn't make any sense. Let's talk about some more bubble watch though, Ryan. And it is again in the crypto industry. Um, we don't want to. We can disregard some of the political stuff here, but let's just say now there's maybe more of an opportunity to be free is the right term to do what you want in the crypto industry with no regard for any backlash or any repercussions. And crypto exchange Kraken, Ryan, which I don't know, is it might be a sizable one, but I don't think it's one even the biggest ones out there, is buying a company called Ninja Trader for $1.5 billion. Now, here's some quotes from an article. Kraken, founded in 2011, offers a platform through which users can buy and sell a range of digital assets, including Bitcoin and Ethereum. The privately held company, known officially as Payword, has a family of brands, blah, 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 blah. Quote, a deal would allow Kraken to offer crypto futures and derivatives in the US thanks to Ninja Trader's registration as a so-called futures commission merchant. Kraken will also step up Ninja Trader's expansion into the United Kingdom, continental Europe, and Australia. People familiar with the matter said. So, the company. They said these exchanges, Ryan said, we don't have risky enough products and we need to go offer even riskier ones. If this, you usually I don't really care about crypto. It's more of a fun thing to talk about. It's a lot of nonsense. It's entertaining. But if this becomes large enough and ruins the global economy, I'm going to be so mad at these people because it wasn't even worth it. It's not like the housing bubble where you have a bunch of homes to live in. It was just all for nothing.
Just for memes? Yeah, it is just look, the business model is risky. I know people are thinking, well, they're actually just a facilitator, it's to them, it's cash flow, right? It's not like risky. But when like we've seen this before, so many brokerages ran into trouble when volume get grounds to a halt. So when there is a slowdown, these are the things that see the biggest slowdown. So yeah, I don't know. I find this who is buying futures on crypto beyond simply
Who
traders?
is saying the crypto volatility isn't enough for me? Let's get even crazier.
Did you see
It's insane.
NASDAQ 24/7?
Yeah,
Or I think
Nasdaq
maybe it's
24.
24/5, but 24 hours a day.
Ugh, who cares? Shorten it. Just right. We don't need. It's not like we. The reason it was open for a long time is because you didn't have the digital infrastructure. I don't know. You just give me an hour or two. We'll get her done. I I usually don't
Yeah,
buy anything in
maybe.
a month. So
I actually don't see any issue with having this open on an ongoing basis if all the transactions are digital because like there
yeah,
are
it's
times
fine.
yeah, it makes really no difference to me. There are times when I'm like, I forget that it's past 3 o'clock or something, and I want to buy at 3 o'clock where I'm at. It's past the end of market close. And I'm like, oh, great. I got to wait till tomorrow. This would be kind of a nice convenience. But yeah, I think it makes very little difference in the grand scheme of things.
It's just to leech more money off of day traders. So that's why they're doing this, to make more money off you if you're going to trade a bunch. All right. I have a serious bubble watch, Ryan. We've been tracking the CoreWeave IPO because we think it's kind of a good harbinger of the AI sentiment. Just kind of this boom we're in and we're watching. It's bubble watch. We're seeing if it's going to turn to a bubble. Apparently, and this is, their pre-trading price of what they're going to sell the IPO shares at. They're aiming for a $32 billion valuation. Now, you can't put an earnings multiple on that because they're burning $6 billion in free cash flow. Earnings aren't really much at all. Revenue, what was it, $1.9 billion, but growing extremely quickly. And with a huge backlog, that should probably see revenue grow to $5-10 billion over the next few years if that backlog materializes. I think, and any listeners who've heard us make our predictions about a $50 to $100 billion IPO price, you might think, oh, well, it's going to be lower than you guys thought. Maybe it's not as crazy. But this is, remember, what they're selling the IPO shares at. I forget the exact terms, but it's before it becomes traded. So this is what it's going to start trading at. And I would bet they're aiming for a bump here because they're just going to restrict the supply as it always goes. And then, you know, they're aiming for that huge bump on the first day. So I think that $50 to $100 billion valuation on the first day is within reach. It would be quite crazy, but you can just see it. Like anyone who's studied market history, that these things pop up. It's going to be on all the national news. It's going to go viral. Oh, CoreWeave, AI IPO, $50 to $100 billion debut, pops 100% in its first trading day. It's coming.
What I'm realizing is they're doing this IPO not opportunistically, but because they probably need the money. Like, I bet the
That
VCs are a
balance sheet
little
stuff.
reluctant at this point to start giving out the checks because they spent what, $9 billion on CapEx? That's hard money to get from VCs.
I agree. Yeah.
Maybe
Yeah.
I'm
There's
wrong.
just,
Maybe I'm underestimating the VC market, but
I wonder how much money they're going to raise. Well, and also a lot of the money they raised was a combination of equity and debt. So they have a lot of debt on their balance sheet already.
who is lending for this? It seems so risky,
No, we'll just package them up.
I guess.
AI backed securities.
I think we're running out of time. Do you want to mention we
Let's.
have a legend in the investing world that passed away. Do you want to mention him?
Yeah, I saw this. This was a nice article in the Wall Street Journal. I think this would be a good, positive way to close things out for the episode today. The Fastenal founder and CEO died at 85. It's a fascinating article. One of the best, what I'd call frugal CEOs out there. If we look at Fastenal stock, Ryan, it has generated 195,000% total return. So what is that? That's over 1,000 bagger. I'm trying to do the math in my head. I always forget on what zeros to subtract.
It's
And that's
almost a
since
2,000 bagger.
almost a 2,000 bagger since 1987, and they've only had one 50% drawdown in their total return. I think with the price, maybe get close to 50%. And here are some, maybe I won't read them all, but there's some very, very telling quotes on his philosophy, his culture, and just his makeup within this article. I'd recommend reading it. The co-founder of Fastenal, an international seller of nuts, bolts, and other supplies for manufacturing and construction firms, took a salary of just $120,000 a year at its peak in the 1990s with no bonuses or stock options. That was less than some Fastenal store managers earned. He clipped grocery coupons and bought some of his suits secondhand for $60 a piece. On business trips, he stayed in discount motels and often shared a room with a colleague. He paid for his own meals on the road. There's no one close to this today. Well, actually, Mark Leonard. Mark Leonard does everything on his own dime.
I'm not sure. I don't know if I understand the pain for meals on your own.
So the company's not paying for it.
No, this doesn't really make that much sense to me on the it's
Well,
just
he's doing it
it's
because he's like
more
saying,
tax efficient, right?
Yeah, well, if you're thinking selfishly, but he's thinking for the company, we're saving the company money.
Yeah, but it's I guess. Like,
It's
not
just
not
it
really.
I mean, it's not it's more of a not a mindset, but more setting the example throughout the company. I mean, if you read the article, it just shows that he really espoused this throughout everything. The warehouses or facilities that they run. I'm not an expert on their business. Would have used desks, nothing fancy. It's kind of similar to the Costco culture. Where we're like, look, we're not going to just have a bunch of pomp and circumstance here. What we care about is driving low prices for our customers. Um, he didn't have a personal secretary. He didn't even have his own parking space outside of the drab core concrete office in his hometown of Winona, Minnesota. And what inspired him to start Fastenal was he graduated from, here's a quote from the article, graduated from a Roman Catholic high school, earned a mechanical engineering degree and MBA degrees at the University of Minnesota, served in the Peace Corps in Venezuela, then worked for IBM, where he analyzed manufacturing costs. At IBM, he disliked what he saw as a top-down management style, and that inspired him to just, similar to a Mark Leonard, just distribute responsibility across the organization. We're going to tell you, look, this is what our culture is, this is what our values are, but you're going to run it for them. I'm not going to be controlling at the head level. I want you to save on costs. You're not going to be spending willy nilly, but just do what you think is right for the customers. And look, I think it just shows, again, I'm talking about this not because sounds like the best life to live, but look at the total return. These type of companies, Berkshire Hathaway, Constellation Software, Fastenal, all these type of companies with frugal CEOs. Costco is another example. They're some of the best performers ever. And here's the final one that I thought was absolutely a gem. Rather than hiring a lawyer to write Fastenal's articles of incorporation, Kierland studied state statutes and wrote the document himself using the blank sides of used paper. In the early days, he also saved money by collecting used candy boxes from a nearby alley and using them to deliver goods to customers. If I read that, if someone told me that they did that, I would say, I'm giving you, I'll invest in your stock right away. Like,
Yeah.
you seem like someone that really cares about generating value for shareholders and is not gonna leech it for yourself.
What a legend this guy was. And you know what? That approach is just so rare. And it does I have you and I seem to have a working theory that being a Midwest company is Minnesota considered the Midwest?
It is, yeah. Yeah, on the west side of the Midwest, but definitely Midwest, yeah.
It's a green flag. There's just
Yeah.
frugality is kind of just embedded in the lifestyle out there, and
Midwest
I
Irish
admire it.
CEO.
Yeah, definitely.
This is this guy, yeah, he sounded like the most Irish guy ever. He's like, "We didn't have much growing up. What do I need this for? I got my we're making we're making some potatoes at home. Why would I go to these fancy dinners? Well, you have $400 million, sir. Uh-huh. I like my potatoes." All right. Well, we're
Yeah.
going long, Ryan. I think that's it. Anything you want to tease? Anything else before we get out of here?
No, we've got some good episodes coming up. We've got Mercado Libre that just released, which was a fun discussion on a business that I seems to have a widening and more and more widening moat, and has just seen incredible growth over the last decade, and probably will continue to see pretty impressive growth. So I recommend checking that one out, and I'll leave it at that. Do you want to take us out, bro, or do you want me to?
I can. If you enjoyed this episode, please consider giving us a 5-star review on Spotify or Apple Podcasts. You can listen or watch to any of the episodes on YouTube, Spotify, Apple Podcasts, or wherever you get your podcasts. We do these live typically at 1:30 p.m. Eastern Time on Wednesday. We recorded this one on Thursday because of Ryan's schedule at that investment conference for his work. But besides that, I think that is it. As a disclosure, we are not financial advisors. Anything we say on this show is not formal advice or recommendation. Ryan and I or any podcast guests may hold securities discussed in this podcast, may have held them in the past, and may buy, sell, or hold them in the future. Thank you, everyone, once again, and we'll see you next week. All right, recording stopped. Got to jet out here quick to a dentist appointment.